Hey everyone, welcome back to the Be Yourself Unapologetically podcast. Now I'm doing visual podcasts. Obviously I can't wash up behind the scenes or anything, so I'm going to do it while I'm talking to you anyway. So it's that time of year and I've got so much to get done, so I've got to do my podcast on the run. But anyway, what we're talking about today is commodities. Let's say the beginner's guide to trading the stuff the world runs on. The dog's is barking, not joining in because some post has just come through the door. Hang on, maybe go and check to see whether the postman's there or not. Get in. Only post. Only post. Right, okay. So, post. So anyway, let's talk about commodities. The things the world runs on. So, the usual stuff we're talking about is like coffee, sugar, gold, tin, aluminium, wheat. So I'm just trying to think of all the different commodities that you can trade. I know there's quite a few. And you know, there's so many people out there saying, come on, get into trading, you know, do this, do that, follow me. But don't go into trading without learning about it yourself. When we're talking about commodities, we're not talking about it in a scary Wall Street shouting into 8 phones type of way. We're going to be talking about it in a grounded, beginner friendly way, because commodities are basically the world's shopping list. Like, yeah, oil, that's what I forgot, gold, wheat, copper, gas, sugar, the ingredients that power cars, build houses, feed families and make modern life modern. And here's the thing, people don't just use commodities, they trade them. So farmers, airlines, mining companies, governments, hedge funds, and yes, everyday retail traders too. So if you've ever thought, how do people actually trade oil? Or why does gold move like it's got mood swings? Trading basically, is it gambling? Just stay with me a minute. So a quick heads up. Before we begin the episode, it's just educational, it's not financial advice. I'm not telling you what to buy, I'm not telling you what to sell. I'm giving you the map, not pushing you into the jungle with a compass made of vibes. So I will just raise the points and let you decide out for yourself. You know, I'm not pushing you into anything. Let's just say, what is a commodity, what it actually is to start with. So let's start simple. So a commodity is a basic good that's largely interchangeable with the same good from another producer. So a barrel of Brent crude oil is basically a barrel of Brent crude. A ton of wheat is basically a ton of wheat. A copper cathode meeting the spec is copper. Commodities usually fall into a couple of categories. Energy, which is crude oil, natural gas. Metals, which are gold, silver, copper, aluminium. Agriculture, wheat, corn, soybeans, coffee, sugar. And livestock, cattle, hogs. So you're trading like real world supply and demand, not just a company's reputation or a CEO's haircut. And that's why commodities can be spicy. Weather wars, shipping routes, sanctions, mine disruptions, OPEC decisions, all of it can move the price. So why do people trade commodities? There are 2 main reasons. And reason 1 is hedging. This is the boring but important one. Hedging is basically insurance. A farmer might lock in a price for wheat before harvest. An airline might hedge fuel costs so it doesn't get wrecked by a sudden oil spike. A manufacturer might hedge copper because copper is in everything from wiring to electronics. Reason 2, speculation. Now that's the trader side, trying to profit from price moves. Neither is bad. The key is understanding which game you're playing, because hedgers and speculators behave differently, but they meet in the same marketplace, like two characters in a pub with completely different lifestyles. So how can you trade commodities as a beginner? Right, here's where most people get confused. So I'm just going to make it clean, like I'm trying to with my pots. There are several ways retail traders get exposure to commodities. So one is futures. Futures are the proper commodity contracts used by big players. They're standardised contracts to buy or sell a commodity at a later date. But futures are not beginner friendly unless you really study contract specs, margin, settlement rules, and the fact that some contracts can involve delivery mechanics. You do not want showing up in your life like an unwanted sofa. So options on futures. Options gives you the right, not the obligation, to buy or sell a futures contract at a set price. This can limit risk to the premium paid, but options and complexity, you know, it can come fast. So commodity, ETFs or ETCs, these trade like shares and can be more beginner friendly. Some track spottish exposure, some use futures, and that matters because futures-based products can behave differently over time due to something called roll yield. But more on that soon. We won't go into that now. So shares of commodity related companies. Instead of trading oil, you might trade an oil company. Instead of copper, you might trade a mining company. But remember, that adds company risk, management, debt, costs, accidents, politics, regulation. You're no longer trading just the commodity. But CFDs. Now, if you're in the UK, CFDs are widely offered and very accessible, but they come with a massive warning. The EFCA has repeatedly warned that a large majority of retail clients lose money on CFDs, largely because of leverage. The FCA also brought in permanent restrictions, including leverage limits and protections like margin closeout rules. So if you go anywhere near CFDs, your first job is to not find a strategy. Your first job is to understand leverage and risk properly. Because leverage turns a small wobble into a faceplant if you're not careful. So the secret sauce of commodities futures curves. So right, this bit sounds nerdy, but it saves beginners from making classic mistakes. Commodities often trade through futures contracts with different expiry months. The price across those months make a forward curve. Two keywords: contango. Futures prices are higher than the spot. Backwardation. Futures prices are lower than the spot. Why do you care? Because if you're holding a futures-based product long term, it usually has to roll from the near month contract into the next one. In contango, you can end up repeatedly selling cheaper contracts and buying pricier ones. That can create a drag on returns over time. Sorry, waving the knife around. In backwardation, rolling can work in your favour. This is the one of the reasons people buy a commodity ETF and then say, Why didn't it track the price the way I expected? Answer, the curve can be a sneaky little gremlin. So, what moves commodity? So let's talk drivers, the big ones. Supply shocks, mines closing, pipelines damaged, droughts, floods, disease in livestock, refinery outages, demand changes, recessions, reduce industrial demand, booms increase it, seasonality matters in agriculture, weather matters in energy, currency and rates. Many commodities are priced in US dollars globally, so the dollar and interest rate expectations often matter. So inventories, stockpiles rising or falling can shift sentiment fast. So what about geopolitics? So sanctions, shipping lanes, wars, policy changes. This is why energy and grains can gap overnight like they've seen a ghost. Positioning or sentiment. Sometimes price moves because everyone's crowded into the same trade and then the door gets kicked open. So a beginner friendly way to start without going full chaos. So if you're starting from scratch, here's a sensible progression. Step 1, choose one commodity to learn. Not gold and oil and wheat and cocoa and copper. Pick one. Become its pen pal. Gold is popular because it's liquid and widely covered. Oil is popular because it's dramatic. Wheat is popular because it's weather plus geopolitics plus seasonal cycles. Copper is popular because it's tied to industry and global growth. By the way, if you hear people talking about the London Metal Exchange, that's the major venue for metals like aluminium, copper, nickel, zinc, lead and tin. So, step 2, learn its personality. Ask, what hours is it most active? What news moves it? What are the seasonal patterns? What are the big reports people watch? Step 3, choose a product that matches your risk tolerance. For beginners, that often means paper trading first, or smaller sized products, or unleveraged exposure if you've invested rather than short-term trading. Step 4, build a simple plan, not a 47 indicator spaceship, a plan. Here's a starter template that you can literally copy, and I'm going to put into the notes. So market example gold, time frame 4-hour chart, setup, break and retest of a key level, entry trigger, candle closes back above level, stop loss below the retest level, target next resistance level, risk 1% of account or less. If wrong, accept it, log it, move on. If right, don't get cocky, just log it and move on. Your goal at the beginning is not to be a hero. Your goal is to be consistent and still solvent. So, what is risk management? And that's the bit that keeps you in the game. So, if you only remember one part of this episode, make it this. Commodities can move fast. Leverage can magnify that. So risk management isn't a side quest, it's the main storyline. Here are beginner rules that actually help. Risk small. If one trade can ruin your month, it's too big. Always know your exit before your entry. If you don't know where you're wrong, you don't know what you're doing. Avoid holding leveraged positions through major news at first. Commodities can gap. Stops don't always save you cleanly in fast markets. Don't average down as a beginner, because that's how accounts get turned into cautionary tales. Keep a trading journal. Write what you saw, what you did, how it felt, what you learned. Your future self will thank you. And if you are using CFDs, take the FCA warning seriously. The stats aren't there for decoration. So, common beginner mistakes. We've all been there. So let's gently roast the usual suspects. So, mistake 1. Trading commodities like they're meme coins. Commodities are tied to real world constraints. Respect them. Mistake 2. Not understanding the product. If you're trading something futures based, you need to understand expiry and rolling. Mistake 3. Over trading. More trades doesn't mean more skill. It often means more fees and more emotional damage. Mistake 4. Following hot tips. If someone online is yelling, oil to the moon, remember, volume is not a credential. Mistake 5. Think one big win means you've cracked it. That's not mastery. That's just variance wearing a party hat. So, a simple first 30 days learning plan. If you want structure, here's a tidy plan. Week 1, learn the basics. What the commodity is used for, what moves, key terms, margin leverage, futures, contango or backwardation. Week 2, watch the market daily. One chart, one news. Note, reactions to big headlines. Week 3, paper trade only. Practice entries and exits. Build consistency. Journal every trade. Week 4, if you go live, go tiny, smallest sensible size. Focus on process, not profit. If emotions spike, you need to step back. Your job isn't to win quickly, it's to become the type of person who can trade without self-destructing. So if you are interested in trading at all, I have a group that I can add you to. You just let me know your name on Facebook and we can add you to a group. Because doing it on your own often ends up with you losing money. Because just jumping in is not going to help. It's not going to work. You need to actually be around people that are doing this. Probably a mentor. That's how most people learn to trade properly. So literally, if you want me to add you to a proper group that teaches you properly, then just send me a comment or anything like that. So go steady, trade small, stay curious. And I will speak to you in the next episode.